Welcome to another edition of MPA TV here at the National Association of Mortgage Brokers annual event in Las Vegas, Nevada. Great to have you along with us once again. I'm Matt Sexton, mortgage journalist at Mortgage Professional America. We've got an esteemed panel today to talk a little bit about what has been overcoming a down year in the mortgage industry. The market conditions have been challenging, but we have three of the best right here that can tell you how to get through any difficult market conditions that you may be facing right now. We're really glad to have these guys along with us once again. We'll take a moment to introduce our esteemed panel who are here early on a Saturday morning to record some MPA TV. Starting off with Eddy Perez, the founder and CEO of Equity Prime Mortgage. Eddy, great to have you along with us again.
Thank you.
Joined as well today by Mike Kortas, the Chief Executive Officer of NEXA Lending. Mike, thanks for joining us for this, especially last minute. We appreciate that. And Tyler Bohn, Managing Director of National Accounts at Deephaven Mortgage. Thank you as well for joining us.
Yeah, great to be back.
Let's talk just generally to get things started about kind of where things are right now as we get to the end of 2025. How do you kind of look generally at the year in mortgage for your company?
It's been a year that was predicted. I think one of the things that people are having challenges with is that they don't want to believe the numbers that are getting posted out there. You know, the market kind of sets the conditions, and then from there is, you know, you have to run your business inside of those parameters, or obviously you can expand out of it. However, I don't think it's been a down year per se. It's been a year that was very predicted when it came to units and volume, and you got to kind of adjust to that. You just can't force it. I think that's one of the challenges that we're seeing out there is people keep trying to force it, thinking a refi boom's coming when, I don't know, 70, 80% of people are below 5%. You know, that's a really tough market to create a refi boom in. So it's really playing to what the market has given our hand.
I don't worry too much about the markets, to be honest with you. I run my business in a way that the markets are working. I'm not changing the markets. I can't control the markets. So the loan officers, I love new loan officers in the industry. We have a university program where we train people because those guys don't realize the market's supposed to be bad. It's the existing loan officers that think the market is bad and have a negative attitude towards it and kind of boo-hoo me and sit around and don't make the phone calls. I like the new guys because they come in and they don't realize the market's supposed to be bad. And they do good and they do really well. I see brand new loan officers kicking the shins of loan officers that have been around for a long time. So I actually enjoy the market. I don't mind the rates where they're at. In my personal opinion, I like them to stay where they're at. But we're a little bit different at Nexus in that category. We win when rates are higher at the end of the day, so.
So at Deephaven, we think you can find success in any market, right? Mm-hmm. That's what we're out there doing is empowering folks to learn about products that are hot in the market. 25 has been a pretty fortunate year. I think a second or third year in a row of good fortune in non-QM, which is where we specialize and bring our expertise to the table. And so we're actually gonna have another banner year in our category and as a company. There's success out there. I think the product innovation we've been thoughtful of over the last couple of years has really opened the doors to continue to sidestep any of the negativity or the reduction in transactions that we saw in 22 and 21.
And I think this kind of ties into what Mike mentioned in his answer. You know, you talk a lot about the new guard in mortgage, and maybe now more than ever, that's so much more important in this type of market, kind of like Mike mentioned. How can kind of embracing that new guard mentality really allow companies to overcome any market challenges that might be out there?
Wow, this is a good question. We can go, how much time do we have?
I don't want to spoil your speech.
No, mine's not on that. I mean, the old guard is just the entrenched powers that want to keep a model that I don't think is sustainable for today. The models have changed, like you were saying about the market and everything like that. So you have to understand what the market has given you. And then from there, just some of the things aren't going to work that used to. And, one of the things that I've told people before that I talked about at my event that you were at was like, one of the biggest things is people have got to get on video. Mm-hmm. I don't really care if it's just on your cell phone. I don't care if it looks terrible. It's better than not doing anything. Like, you really have to be a brand. People want to know who you are, not just what product you provide. They don't want to know what you provide. They want to know who you are as a character. And I think a lot of leadership, you just keep hearing, I jokingly call it the Paul Revere syndrome. Every 6 months, I hear that the refis are coming. The refis are coming, and I think it's the funniest thing in the world. I think there are little pockets of opportunities of refinances. However, I don't think it's going to be this gushing 14 million units like we saw in 20 and 21 that everybody's expecting. I mean, just to give it some perspective, one of the big things for the new guard is Are you doing second mortgages? I've asked originators. This year alone, second mortgages have exploded even further because there's almost 40, it's like 35, 40 trillion, give a number, of equity. As well as with so many baby boomers getting to that later stages of life, there's going to be so much wealth that transfers. This is such a golden opportunity. However, this isn't the post-crash Dodd-Frank model where there was quantitative easing, where the government artificially kept interest rates low. You have to understand, this is normal. I don't think this is, to your point, bad interest rates. This is just a normal interest rates, that are not, as I jokingly always said, the QE era was kind of like the steroid era in baseball, when all of a sudden second basemans were hitting 50 home runs.
That's right.
Yeah. Interest rates were at 2 and all that. This is normal. There's nothing wrong with that. And you have to understand it. I just don't think, I think everybody just keeps thinking, okay, refis are going to bail us out, margins are going to come back, and they're not. The bondholders aren't paying as much. You're not making 104, 105 on loans like used to be because of we churn too many loans, servicing values. So there's so much, if people understood how it's working, instead of stressing the business, hoping like, oh God, they watch that 10-year, like, oh my God, I'm watching the 10-year go down so much. It's like neuroticism. I'd say look, don't even, to your point, pay attention to rates. Build what you can and go with it. But you have to let go of that time period. And the problem is, it was so lucrative in so many units. It's like the girl that got away, instead of understanding it was just an anomaly.
Yeah, absolutely. It's kind of a follow-up to you two, kind of on that same thought process. All these customers that come in and they turn on the news and they hear about, oh, we need to cut rates, we need to slash rates. So they keep hearing that this fictional, I say fictional, that's probably editorializing, this fictional rate drop is coming because that's all they hear on the news headlines. How do you work with your customers to kind of change their mindset and get them thinking about the things they really should be thinking about when it comes to doing a mortgage?
So I tell my loan officers to look at the numbers that really matter. If you want to really predict rates, watch something more like inflation or the treasuries, right? And I chuckle every time the Fed comes out. Let's drop rates. Watch every dumb loan officer go talk about how rates are coming down. And I'm like, there's your idiot in the market. But, and I hope it's not some of mine. I'm sure a few of mine try to take advantage of the clickbait on that one, but it's comical. You got to educate your consumer. But if you're a good loan officer and you educate your consumer to what's really going to happen with the Fed, when the Feds do those things, and what you say is a little bit more accurate than what actually ends up happening. I can't predict perfectly what's going to happen to the rate when they do it, but what you say is a little bit more accurate than to what everybody else is saying. You're going to escalate yourself. Tell your customers the truth. Learn what you're talking about. Know your trade. So many loan officers in this industry don't actually know every aspect of this business, and it's sad to me that this is where you're depending on your income, but you're not actually learning how it really works, how this industry really works, how your rates are really made. But good loan officers, rise to the top in those categories.
I'd add, a great salesperson, a great loan officer is not strapped to one value proposition to their customers.
Yep.
And so if you're going to make your strategic trajectory based off rates, in the long run, you're going to lose. There's always going to be somebody else out there with a better rate, right? You can see that across any product, not just in mortgage. So while it is clickbait, maybe it can create some lead gen, I wouldn't advise a loan officer to get on the phone and start a conversation around rate. It's benefit and what does the borrower want to accomplish. If you're talking to a new home buyer, a first-time home buyer, where the rates are today actually creates a little better positioning due to less competition of buyers. And so if you find the right property, the gain in equity based off of our inventory levels will actually offset 25, 45, 75 basis points over the next few years. And tying it back to the old guard versus new guard, from a new guard standpoint, understand what products are driving the market and adopt them early and become an expert. For the old guard, you should have a tremendous amount of pride in how many families you helped get into a home under 5%. And you've already invested in building rapport and trust with them because they've done a deal with you. They are phenomenal referral sources in this market. To be able to call them back and say, hey, your kids were in high school when we did this loan. Are they going to college? Do you need to help pay for that college? Are you prepared for that? So they can shift and have a wealth conversation And then rather than chasing the 5% of realtors that control 90% of the listings, you're actually opening up an opportunity and reinvesting in a relationship that you already started, and providing them with access to capital through using home equity products, which are driving the market today. And all of those folks that now trust you a second time have friends, relatives, neighbors that are in the same position, right? So it's another way to think about how to differentiate yourself and get into some natural referral networks or expansion in a market that hasn't seen the transactions that we've seen over the last 5 to 10 years.
And you both talked a little bit about the HELOC market. I was going to get into like the products that brokers should be looking at right now in the current market. You mentioned HELOC. I've had a few brokers talk about ARM loans. What are you guys seeing? And all of you can kind of take a swing at this as far as products that brokers really need to make sure not only are they using, but they understand to be able to give those to the customers and give them the best tools right now.
We're fairly well diversified within non-QM. By definition, a second lien is a non-QM product. And I think a lot of people forget about that. But it's the second fastest growing product over the last 12 months, right? The investor community, we'll get into that in a few minutes, still kind of drives most of the traffic. But we actually have second lien products for investors, so you can kind of double dip with product options when you're working with investors. But it's critically important. We mentioned the stats about how many people still have a sub 5% or a sub 4% loan. A large portion of those folks are not leaving their home anytime soon. They can't afford to buy up. They can't afford to buy down. It's probably not smart to buy down unless you're going to change your tax base and get to a new state. So there's a tremendous opportunity to, again, re-engage your network of families that you've helped with home ownership and change it to a wealth conversation, right? Whether it's, I mentioned investing in your kid's future with college. We have an aging housing stock across the country. I think the average house is, slanted with the West, which is a little bit newer vintage, but the average housing stock is plus 40 years. Folks who've now been in their home for 5 to 7 years, and they're going to stay for another 5 to 10. They're going to want to reinvest in that property. And then, lastly, which is a good spot to be in if you really have this conversation with your customers from a loan officer to a borrower perspective, is there's a great opportunity to leverage actually a really good cost of capital with a second lien and get into an investor strategy, right? There's many homeowners that kind of always wish that they owned a second home, or they want to buy their first or their second investment property. Or with the home affordability situation, they want to help their kids buy their first house. So there are a lot of opportunities if you embrace and become an expert in second liens. Cachet is HELOC, right? But there's actually a cascade of products that actually can support that solution set, rather than setting an expectation that a broker can come in and compete with a credit union on a HELOC. It should be more about defining the values, the benefits to the homeowner, and then bringing the right product to them to maximize what you can do for their strategy. So it's been a phenomenal engagement tool, not just from an investor to a loan officer perspective, but from a loan officer to a borrower perspective, to really help them find success in today's market.
I can double down on all that. I have the pleasure of working with both of these guys in a wholesale market. These guys are both one of my top investors, right? With our NEXA 100 product. And the proof is in the numbers for me. If you look at the top 1% of all my loan officers, the vast majority of them are focusing heavily on the DSCR transactions, and they're utilizing HELOCs in a format to get those. You even have HELOCs now for second homes and all those things. So you can tap into the equity that you had in those things. And it's the loan officers who are actually doing those things. Some really, old school traditional loan officers, let's call them old guard loan officers, right? They don't want to change. And I got to brag on my NEXA University program again, because a lot of our top 1% of our loan officers came out of that program with no perceived mindset of how this is supposed to go, and they're doing these things. They're reaching out to their clients. They get a client, they get a loan, they follow up with them and say, hey, why don't we pull HELOC? Let's get you a DSCR. I'm actually really concerned that one day with all the DSCR loans, people are not going to have much other options to rent, but to rent, because so many DSCR loans are now being done at such a heavy level that the people who get it, The loan officers who educate their consumers to get it, those investors get it, and they're buying as many of these things as they possibly can. They're not always the largest loan amounts, right? But the unit count is enormous, and their wealth is all going up.
Cash flow.
And then they're using that, and they're getting tired of their 5,000 square foot house, and they decide they want an 8,000 square foot house instead because they're doing so well on all their cash flow opportunities. So the proof is in the numbers, and the DSCR and the HELOC transactions that we're doing at NEXA are as far as unit counts, are scaled pretty heavily.
And a touch further, there has been a growth in the ARM market. It's funny that you brought that up. I've seen it on the government side. Because what you're seeing out there a lot is the 5-1 ARM and the 3-1 ARM that's coming in. And then some people are like, well, what happens if rates go down years from now? Well, I'm going to tell you, a first-time home buyer, the interest rates on those 5-1 ARMs are like 1.5%, almost 2% lower. And even if worst case scenario, when it adjusts on the government loans, it can only adjust 1%. So in a lot of cases, you can be in the best case scenario 6-7 years into that loan. Best case, like worst case scenario, is still better than had you started. So I think from an affordability standpoint, it's going to expand it. Now, I wouldn't tell somebody to go buy a bigger house just because you can have a 5-1 ARM for those years. What I would just say is, if your budget is, say, this amount, then just enjoy that time period. You know, cash flow more, pay down your mortgage more if you want to, or save up. I would always say save up more cash because you always need rainy day funds. But you're definitely seeing the ARMs. I'm not seeing it so much on the conventional side as much as I'm seeing it on the Govy side. I definitely am seeing more and more of that ARM market, and it's been growing because we've been looking at the securitizations on a month-to-month basis, and you're seeing those grow. Because I do believe, a 5-1 ARM is a pretty good product for a first-time home buyer, as long as, like I say, they're not taking that lower payment to try to go stretch themselves. I want to be very clear. We don't need 2008 again. What I'm saying is they take that into consideration. Because even if it adjusts twice, it's going to be about the rate they would have taken on from the beginning. And that puts somebody in the first-time position in a very, very good position to be more successful out of the gate.
It's funny you say that because I just talked to a broker about the property tax situation in Florida, and they were like, oh, well, if people want to pay property taxes, you're just going to take that extra money and buy a bigger house than what they're getting now instead of just actually trying to get ahead at the current rate. But let's talk about the non-QM because you mentioned it. Let's kind of pivot to that space because it feels like there's non-QM lenders just coming out of the woodwork right now because it's such a strong space. But, for brokers who are looking, maybe haven't gotten into that space as much as others, what should they look for when they're looking at the non-QM space? And maybe what are maybe some of the red flags in the space for maybe some of these companies that are just kind of coming out of nowhere? When brokers are trying to get there, what should they be looking for?
Yeah, that's a great question. It is becoming a crowded hallway. Actually, when we get out here to the exhibit hall, there's probably a 7-to-1 ratio of folks that have a non-QM product or a way to get there. Look, we need the competition, right? No one company is going to be able to educate 100,000 loan officers and get them going in that direction. So that's healthy. I think in terms of what a loan officer should be looking for or a broker should be looking for, relative to a non-QM investor or partner. Expertise is critical. You want to work with somebody that's been there, done that. This is not their first transaction or even their second transaction. I think Deephaven's proved as the pioneer of non-QM that we've been around a long time and we're not going anywhere. Access to tools and resources, right? Are you working with somebody who's got a deep enough bench that can support your knowledge growth? Do they have a scenario desk? Do they have more than one product? From a risk red flag perspective, I'd be leery of working with somebody who's, focused on products on the edges, right? That's where liquidity could evaporate pretty quickly. And as important as it is to maintain trust with your borrower, the last thing you want to do is have someone in a position to move, and then that product doesn't exist when you get to the closing table. So there's still a little bit of that around the edges. Some of the other, I think, great things that you should be looking for in a non-QM partner is actually tenure or experience of the account executive that you're working with, right? We do see a lot of movement, right? As more participants come on stage, there is a little transfer of AE, but I think it is critical to work with somebody who's shown that they can be successful at a company for a long period of time. right? Grass isn't greener across our industry. And so, I mean, this plays for all of us, right? Talent is critically important, having a culture to keep people there and keep them committed, but working with somebody who knows the systems that they're going to walk you through and have shown that they've been on top of their game for quite some time is a great way to get started in this category.
Well, you mentioned culture, so let's dive into that. How critical is that? Whether it's a brokerage, whether it's your company, in building the right culture to make sure that the talent that's there is fostered, but also is kind of pulling in the right direction, so that they're taking the message that they need to take out to the customer.
Look, I'll start on the culture. I think culture is absolutely everything to growing a sustainable, long-term or large organization. If you don't have the right culture, somebody will leave for the stupidest thing. If you don't have the right culture, they'll leave. You can't grow without it. You can't sustain without it. I tell my folks all the time, even my biggest producers, I says, I will not trade money for culture, ever. I says, because if I have the right culture, the money will always come. Because to me, I look at longevity. Like, I have an extremely high compensation plan, right? My loan officers love that. It helps create a culture because they like to defend it a lot as well. But that's good. It's small money over very large periods of time, rather than big money over a short period of time that loan officer would leave. I will take that small money over a long period of time, which you have to have the right culture. I'm really proud of what we built at NEXA with the culture being a virtual company, right? But it's trade shows like this. It's the trade shows that these guys put on, the events that they invite us out to, that we can come out there and we get a promoter to our people. So we still get to see all of our people all the time. We just don't have a physical offices that we actually attend to because we're in a virtual environment. But we've been able to create a ridiculous culture, large and wide, because of the broker network out there. The broker community out there has a lot of events that these guys still travel to, and we do a lot of we do monthly events with our loan officers that they can come to or not. But culture is, at the end of the day, it's absolutely everything, in my opinion. No money will follow you if you don't have that culture. So if you don't have it, you better figure out how to create it.
And to piggyback a little bit what he's saying, culture right now in this industry is very tough. And I've spoken very open about it because, unfortunately, after 2008, with Dodd-Frank and what went on, this industry basically became a mercenary culture. And everybody was trading something for this or for that. However, I don't even think that's the toughest part about the culture right now in the industry. What I'm seeing throughout every organization and people that I talk to is the same thing, which is 2020, 2021, the operations staff literally made 200 to 300% more, and they cannot wrap their brains around what is the new guard, what is the new thing. That's where I see why so much tech, AI, and offshoring coming into play. Because something that, you talk about culture, no one ever goes to tech, AI, or even offshoring a job for cost. It's for culture first. Mm-hmm. Because what happens is sometimes, unfortunately, and you can study these transitions that have happened, like when Detroit was 90%, GM was 90% of the car market, and then this small little company named Toyota came in and by culture changed it. But at that point, nobody cared about quality. So I think culture, not only is it everything, you got to really demonstrate it, you got to do it virtual, you got to do it in face. But the real challenge that I see in this industry right now is the operations folks, for the most part in the industry. They just cannot get over what they used to get paid. And that is one thing that has been very predicted, and you just see it over and over and over again. And you're seeing a lot of abuse, from lawsuits to this to that that's going on. And that's the unfortunate part, is that I think culture after 2008 did take a major hit in this industry. One of the things that I say is I think, at EPM we have a good culture. Some people think we have a great one. I don't think we have a great one yet. We're in the pursuit of it. We're always chasing it to get it better. I just think so many of them are poor. When something's poor and you're good, you look like you're a hero, even though I would rate us probably in the mid 80s if I was gonna score it. I think there's a lot more that's gotta get done to make the experience less stressful, because that's what it is. Culture is important because what it is you're taking stress and you're removing it off somebody else's plate so that you can have a common unity towards a goal bigger than themselves. And I think that has been lost. I do believe the more that this market stays this way, eventually culture will be back, but I still think you're a good, we've been in this slowdown for 3.5, 4 years now, because it started A lot of people weren't paying attention, but the second half of 21 was slower than the first half of 21. Right. So you're about 4 years slowing down, and some people are still holding on to the old guard, the old ways, the old beliefs, the old habits, and they just got to move on. You know, nobody had a problem with their compensation in 2019. They had a problem with it in 2022, all of a sudden. They had no problem with it, even though the units aren't even there and the revenue's not there. But as much as you explain it, but yeah, you have to be very, to Mike's point, to Tyler's point, you've got to be very radically candid. That's all you can do as a leader, is really lay it out there and be consistent. And that will help build a culture.
Can we stop talking to the banks and changing the old guard too quickly? It's really working for me, for them to keep that.
Hey, buddy, let me let you in on a little secret. The old guard is going to hang on till they hang themselves.
Good.
You don't have to worry, because we'll see it here, we'll see it at the next conference. People are like, no, man, this is what's gonna. You don't have to worry, buddy.
Good.
They're gonna.
It will keep growing.
It's like after 2008 and the crash, I would hear for a good 5 or 6 years, about 6 years, I'd hear, oh, we used to do this at my other company. But, oh, how's your other company? Oh, they're no longer existent. Then why do I want to listen to what you did?
Right.
Trust me, we've been in this cycle before. The old guard hangs around a good 6 to 7 years past their due date. And we're at least 3 solid years into the refis aren't coming back. So don't worry, you've got plenty of runway, buddy. You can probably be at 8,000 LOs by the time.
I've done nothing more than grow in the last 4 years, so this works well.
I would say those people were not going to change no matter what. Like
kicking and screaming, like sadly they may destroy their careers. That's really sad.
Yeah, it's hard to teach old dogs new tricks, but we try every day, and we are seeing some success, right? There are several of those folks that have invested the time and made this a career. And they just need some guidance, right, to get refocused and redefine what good looks like in this market. And most of them have been around through a couple cycles. This shouldn't be new to them, right? But yeah, 2020, 2021 really changed what everybody thought was the playing field, and we're still bouncing back from that. But the folks that have been doing this for 10, 15, 20 years now, they were slow to adopt, but now they get it, and they're turning a corner pretty quick. And I think, they're mentors to a lot of the new folks. They're coaches to a lot of the new folks. So to the extent that we can help them kind of understand what products are available and how to leverage that to build out a lead strategy and a business plan, they're critically important, right, to the newer folks that are coming in and need some history lessons.
There's certainly some that have been around that are adopting that new guard mentality, and they're the ones that are going to thrive in this market, both on their own, but also as a mentor to others. Well, let's pivot a little bit. I wanted to talk a little bit about the new home construction market and we'll start obviously in the non-QM space. You hear all the time about shortage of new homes, and that's obviously, we've even heard in the headlines coming from the government about trying to force big builders to build these new homes. As brokers kind of look at this space, what do they need to know about new home construction or even fix and flip, and what trends they should be looking at in that space?
The data's there. I think consistently it's kind of a 4 to 5 million home gap that we need to make up in the short run. Over the course of the next decade, I think it's closer to like 18 million relative to demographic forecasts. It's a phenomenal opportunity for a broker or a loan originator to participate and help with what's perceived as the housing crisis in America, which is the inventory issue. So we've got a cascade of products that help originators get further upstream in that life cycle, which opens, again, additional doors, right? So if you can partner up with the right investor, builder, developer, and provide capital for them to go in and actually build homes or rehabilitate homes, that's actually gonna bring you a cascade of additional borrowers that you will be the recommended specialist to help with that final loan, right? When that property is built or rehabbed and somebody's moving into it as a first-time home buyer or as a step up, depending on how sophisticated the build is. So it's fantastic. Residential transition loans, which include fix and flip and investor bridge. Sometimes there's multiple transactions that happen, right? And it's becoming competitive to compete for land. I'm out in the West, Southern California. We're running out of land in places where people want to live. But there's a lot of aging housing there that needs an investor to come in and actually invest in that neighborhood and bring those houses back up to what's desired in today's market for a first home buyer. And that investment is a critical place for a loan officer to play as they're creating their personal brand and becoming an expert to open more doors. Real estate agents are fantastic lead sources, but they're not the only lead source, right? So if you can broaden that out, I mentioned your existing book of business and how home equity plays there. Investors are driving 30% of all purchase transactions. They need access to capital, and they need it before they get to a 30-year fixed DSCR. They're going in and acquiring homes and investing in those homes and then turning them into rentals or reselling them and controlling the participants in that transaction. And so if you can develop those relationships with them, you can play a healthy part of what America needs, which is cooperation as it relates to making up that gap of inventory.
Mike, what are you seeing on the broker side as far as that space?
I get frustrated at loan officers in the broker space side when it comes to like builders and those types of things. We have a much better product for these builders. We can do a lot better credits and things of that nature, but loan officers in the wholesale space, not all, because some do very good at it, but just in overall general, the retail space is still doing a better job holding on to that client. And to me, it's frustrating. So we want to set out, and we just brought on a big time builder loan officer to NEXA, a big $150 million a year producer. And we're going to use his model and build something out so that other brokers can actually get into that space and have a better run at it. I'm seeing, and I don't have data for this, but it's just what I can feel and touch a little bit, that the builders can see the value in the brokers, but the brokers aren't doing enough to reach out to them. Almost like they expect that that's not our business lane. And that's unfortunate, and I think brokers need to do a much better job in this space. We do a great job in a fix and flip, right? We do an outstanding job in those markets, but I think we can do a lot better job in that new build, new home market. So that's one of our big focuses for next year.
And you touched on a point that we touched about at your event, which was a great event, just 2 weeks ago, that a lot of the retail originators are better than the wholesale originators. And that's, bitter to say in a sense of, well, why is that? Because they don't give up on something. And that's one of the things that I'm seeing, that some of the broker community in that space is saying, oh, well, they have their own mortgage company. A lot of builders have their own mortgage company, but I'll tell you, a lot more do not. And as well as that is, a lot of them need what they call the turn down lender. They'll only do, say, above, nothing below. I mean, I've seen builders that do, if it is a 699, they won't do the loan. Wow. They won't do the loan. It's 700 because they put it on their books. They retain the servicing, anything below. So then there's plenty of business to go around. I've known so many people that have built careers being the number two to so many of these builders. So they just got to go out there, and you got to understand with builders, it's like watering and building a garden. It's not going to be instantaneous. Every once in a while, you'll hit a home run with an agent and get business really fast. A builder, they're a construction company. They need to move product. They're not so worried about the real estate agent or your side of the business. They need to move product because they're on demands. And they're not just going to hand over a neighborhood or something that fast. So you've got to work it through the system. You've got to get involved. You have to get involved with the Home Builders Association. However, like Tyler said about the data, yeah, we are 4 or 5 million in the hole. There is a huge opportunity. And then with demographics, between Gen Y and Gen Z being so large, see, our generation, Gen X, was like half the size of Gen Y. And that is also what led to the financial crash. People don't realize that the crash was more a demographic problem, and that's why there was oversupply and under demand. Well, this is inverted. We are at I don't even know how high you want to put it, of demand and supply down there. So when people are saying, oh, real estate's going to crash, it's the basic laws of supply and demand. I mean, could it soften up? I'm not going to say it couldn't, because people made so much equity that, yeah, they may sell for 30, 40,000 more because their house went up 300,000, 400,000, and they're not going to leave that chips off the table. But I think you're going to see more building. I think there's going to be more products and more opportunity, especially for the wholesale community, if they're willing to take the time to invest in it. And the good thing about a builder business, they're going to keep building. They create I mean, you want to attach somebody that is creating the supply, or like in Tyler's case, like investors are in a sort of way creating supply themselves because they're wanting to buy multiple places. That's a good way you got to go with. That you got to go with not only the home building, but then the investors that are building supply by adding more units under their portfolio. So
the institutional builders only represent about 35% of the production that happens every year.
Wow.
Yeah.
65, the majority of the production is happening from localized kind of regional down, and scattered lot development, whether it's ground up construction or the rehabilitation through a fixed program, is the opportunity for most brokers in their community.
Yeah.
And that's where brokers really need to do a better job also of utilizing that and explaining that to these builders, because brokers have the tools. I mean, when you work like lenders like these guys are rolling out new and innovative products too, making changes to certain products to make them better than what they once were. Right, so you got to work with lenders like I have over 70 lenders who say they do DSCR, right? But we want to work with the ones who innovate those things. We want to work with the ones who are putting out new products. I don't want to work with this one that's just replaying a product out there just to try and scrape out $1, white label it or something, right? I mean, Eddy just rolled out his adjustable rate mortgage program for the Govies, and it's been an immediate success. So you got to work with lenders like these guys that.
We're about to roll out the 3-1 too. That one's in the process too.
But this is what you need. You need lenders who are going to do these types of products, because especially on these builder accounts, because these builders need these things, right? They need those turned down products. Yeah, if they're going to do it in-house and make the money, they're going to do it in-house. There's nothing you're going to do about that.
Yeah.
But there are so many. I mean, Eddy will underwrite a manual underwrite for me down to a 500 if I ask him to on certain Govies, right?
Yeah. VA.
We're not trying to do it on every single deal. Don't get me wrong, right? We're not, advertising, but we can do it. But we can tell our builders, hey, you have a client that, let's see if that veteran really can get into that house.
Yeah.
Right? We don't have to have an AUS approval to get that veteran into that house. We can ask Eddy to underwrite that, and he'll take a look at it. That's good. Those ones got some hair on them. Yeah. Expect it.
Yeah.
Right? But if they can be done, they can be done. And those builders need those accounts, and brokers have them.
Yeah. Well, brokers have the flexibility. Mm-hmm. They have, and say they only do business with 5-7 lenders. You can have an array of product in 5 or 7 lenders.
We have 5 NEXA 100 lenders, and you guys cover over 90% of the products.
Yeah, you can get there, but you have the flexibility. I tell them lean into the flexibility.
3 guys, by the way, but
don't lean into
Keep us competing.
Yeah. Lean into the flexibility. That's what they need to do, instead of like, oh, I just send my loans to this place or these 2 places. And I'm like, yeah, you're pigeonholing yourself. Don't be pigeonholed. There's plenty of stuff out there. And to Tyler's point, there's plenty of people that are willing to educate you. We're educating on the 5-1 ARM, because a lot of people, they didn't grow up with ARMs the last 15 years, so they have no idea. Even internal staff, I'm like, okay, let's not mess up the paperwork. This is very important. But yeah, you gotta keep educating, keep getting the knowledge base to grow.
Yeah, that totally makes sense. That's great insight on all that. A couple more questions before we wrap up today. I want to get back and talk a little bit about the online presence for brokers, because I've heard you speak about it before, and we talked a little bit earlier about creating that online presence. And it feels like, I know it's cliche, it's never been more important, but it does feel like that right now, if you don't have an online presence, it's like you don't exist. How do brokers find a way to just take that step and, like you said, just get out there and start doing it?
I think I saw this online, and I thought it was pretty cool. There was some 30-day challenge, 30 videos for 30 days, or was it 90 days?
90 days.
90 days. I say do something like that. Mm-hmm. I forgot who kicked it off. But if you do a video for 90 days, I mean, actually, they technically say it takes about 66 days to form a full habit. Because what happens is a lot of people can do a habit for 21, 30 days. It's that next 30, when nobody else is watching and it's not new anymore, that gets crushed. So I would say if you did the 90-day challenge, I think you will be in the groove. And I would also tell somebody, throw in some fun stuff. Mm-hmm. They want to know who you are. It doesn't have to just be about work. It could be about your sports team. It could be about your kiddos. It could be, I was silly enough when I got here. I can't believe most people hadn't even heard this, but I took a picture when I got here and I said, I made it to lost wages. I can't tell how many people... I heard that like 20 years ago. I was like, how is this so new? But it's knick-knack stuff like that. And here's the crazy part is, I'll put out videos, and you guys will know that. You'll put out some great piece of content, it'll get barely anything. Mm-hmm. and then you put out something like lost wages and it's exploded all over. But that's how you got to connect. You got to show all of who you are.
One of my best videos, it was a selfie video, and I was out feeding the chickens. I said, look, I want to talk to you about the mortgage. Hey, check out my chickens. And
you went with your dog too, right?
And the dog. And everybody, we got the dog, we're just playing fetch with the dog, talking about mortgages, playing fetch, right? And everybody loved it. So
You gotta have some fun.
Dogs are key. Animals are critical.
They work every time.
That's right.
So.
And it can be simple. If you're camera shy, I think 2 of my 5 top trending posts over the last couple of years is actually my hat on an airplane, right? Because I travel a lot in the name of non-QM and helping with the housing crisis here, or the perceived housing crisis, and getting confidence back into the industry. And there's times where maybe you don't have something clever to say, right? But if you're gonna do 90 days, you're gonna need a lot of variety and a lot of pieces. Start slow. And there's a tremendous amount of education and how-tos around faceless channels, right? Now, I think it is critically important because our transactions are relationship-based. They're built on a high level of trust. When that evaporates, the industry has an issue. So I think an online presence really is kind of this generation's way of building that rapport with clients that you may never shake hands with in person. And so if you can actually build some comfort in people getting to know who you are through an online presence, it's a fantastic way to build a business. And I don't have the stat on this, but if you're building out a business and your job is to get access to more people who are interested in your product, you have to have an online presence. It's probably the lightest weight or most efficient way to build out a lead platform for yourself. And so if you're not on LinkedIn by now, I think from a retail perspective, if you're not on Facebook and Instagram, you're missing a tremendous opportunity to interact with folks that are going to want to do business with you as they get to know you and trust you.
I will jump in on the online presence and social media. Two points on this. I think brokers can have a slight edge on this sometimes because they don't work for the big banks with the compliance departments that are saying, well, you can't do this, you can't do that. Well, we don't do that around here, right? As broker owner, I'm like, just don't say anything illegal. And if you're gonna quote a rate, you better have an accurate APR. Just don't quote the rate, by the way. And by the way, nobody's listening to the damn rate anyway.
Right.
Just talk about the product or how you can get something or do something fun, right? So brokers can actually have a slight advantage on this, and brokers do a really good job in their online presence. And I will say, depending on where technology goes, depending on if AI can actually take over this side of the business, your online presence will become everything. You will have a 20-year-old TikToker who is just destroying the production levels of the entire industry and killing all the old guard guys, right, that are scared about what they're gonna put out online just because they're able to reach so many people. Because all you're gonna need is an NMLS license, right, and a good AI platform, and the loan will do itself damn near in the future. If that technology gets there, depending on how long it comes. I don't think it's as far out as some people think it is, but it'll be absolutely critical to get your online presence secured. I'm actually really personally, I used to do a good job doing an online presence. It was a little negative, so I'm going away from that. I'm going away from that, so I gotta rebuild my online presence, right?
Re-image.
Right. So, but I'm a little disappointed in my current one just because I haven't been doing it as regularly as I should. I need to get a hat. I fly in the planes a lot. I'll put the hat on the plane for you. We'll do some. We'll have some joint fun. We'll have some joint fun in there.
And you've been to it. That's one of the things that we do is we teach the broker community with our program, Empowering Brokers, on how to create this content, how to work around it, how to slice it up, how to do it, because you have to show the way. That's one of the things you have to do as a leader, as an organization. If you really want to bring true impact, a true pay it forward attitude, you got to do stuff like that. But yeah, when you guys showed up in the Empower Brokers, so many people have really, really enjoyed it and then said, oh man, and look, some people are only doing 3 videos a week, but guess what? 3's better than 0.
That's right.
They're doing more.
That's right.
They're doing more.
I think we're going to get to this, but I'll just throw it on the table. I think 2 pieces are really important if you're going to go down this path from a tactical standpoint. Number 1, speed to lead is still like the most important concept when it comes to sales. So if you're going to make yourself available online, either you need to be addicted to the follow-up or you need to have a team member that's going to take on that follow-up for you.
Yep.
Right? Because there are going to be people that reach out to you, and there are so many folks trying to gain attention for what is perceived to be few borrowers, that if you're going to have a strategy where you're going out there to create attention and create leads, you need to be on top of that follow-up. And that's not like tomorrow morning I'm going to read yesterday's direct messages. 20 minutes. It's 20 minutes, right? Like the attention deficit of what's happening across the globe, but especially in America, is a little scary, and you need to be prepared to react to it.
It's an ADD world.
That's right.
ADHD, sorry.
That's right. And so the other piece of that is it is a low cost investment to build out or utilize tools or team members to do this, right? So if you're camera shy or you've got some tech debt and fear, there are plenty of folks that you can bring in and invest in to help you build your brand, to help you create that flow. So you don't have to do it on your own, right? And if you're into self-help, jump on YouTube. There's plenty of tutorials. But there'll be plenty of platforms here this week that, compliance is one feature, but convenience is another. There's a handful of tools out there that will guide you through the process for less than $1 a day, right? And they will help build up that confidence and give you tools that will help you build out using best practices. You can still bring creativity. You can still bring your dog to your video, right? But you don't have to go build a platform. There are enough participants here that have solved that problem. You just need to plug in and make it a habit and invest in yourself, knowing that it's a requirement in this market to have an online presence.
Yeah, I'll touch on the lead to speed thing. Yeah. Right? It's critical. But at the end of the day, there's no excuse for it either. You're a lazy loan officer and you shouldn't have been doing the marketing to begin with, or you're just not using the right technology. Look, I got an agent that I'm training, picking up on the keywords here, an agent that I'm training. His or her name is Terry, T-E-R-I, and he or she does not take time off. She will answer the call at 2 a.m. They will answer the call at 2 p.m.
AI's
right? They don't take maternity leave. They don't ask for sick time. They will answer every single call. And by the way, they'll answer 7 calls at the same time, right? This is available already. And it's very intuitive. If you get the right one, right, it's very intuitive. Some of them sound like a robot. Don't use those, right? If you got an AI that doesn't sound like a human to you, don't use it. There are ones out there. Do they cost more? Yes.
But it's not
There's
crazy.
reasons it costs more, but it's not insane.
They're not really expensive.
Right?
It's
Especially
crazy.
if you're at an individual. And now if you're doing it at a massive company-wide level and spin, right? I can understand why just a couple extra pennies will add up fast. I get it. But as an individual loan officer, there's no excuse for this anymore. There are so many voice AI platforms available that do this, that you can very quickly train to do this. Like, we're rolling it out for our entire loan officer staff, that every single scenario that you can imagine, wherever that lead source came from, it will be able to call that and get it going, and then transfer that call to a live loan officer if that's what they so inclined, including an AI. We're about 75% of the way done with it, a voice AI technology that will take the entire application over the phone, and it knows when, right? If you're W-2'd, it knows to ask these questions. So it can do those things. Those things are out there.
Absolutely.
And they're available, and there's no longer an excuse for that. So don't do the marketing if you're not going to have lead to speed. Just don't waste your time.
It's interesting you said. I just talked to an analyst from JD Power yesterday, and he said that the race is on to get to this almost completely AI process. And he said it's going to happen soon, and the first ones that get there that embrace it are going to dominate. And that's certainly something everybody needs to be thinking about. As we get ready to wrap up today, I always like to end on a bold prediction. We've got 2026 right around the corner. Believe it or not, we're almost through 2025. It's been an interesting year to try to predict exactly what's going to happen. So if we look ahead to 2026, what is one bold prediction you think about the mortgage market, whether it's your company, whether it's the market in general, whether it's brokers, that we can look back on this time next year and see if it came to fruition?
I'll go first. I like being bold. I think the transition of originators from retail to wholesale is going to go up another 5%.
I actually agree with
About, I think, wholesale or third party, whatever you want to call it, wholesale, non-del.
TPO.
TPO. I think that there will be at least a 5% growth overall in that market, is what I would say.
I can tell you, having the largest mortgage broker in the country, that we are seeing massive amounts of production in that retail space that is now starting to say, hey, maybe it's time.
Oh, that's old guard. They're switching to the new guard.
They're saying, but it's the big producers.
No,
And there are some very large, significant, they still control the very large, significant producers in the markets. But those guys are now starting to see through the sign-on bonuses and realize how detrimental they are to their entire team. We're able to pick out their team if they take one very easily and undercut their team, say, how much of that did you get? Right? But we're seeing very large amounts, and we're going to announce in a couple of days, actually, hopefully tomorrow. Maybe we'll have to talk.
Yeah, absolutely.
A very large, significant C-suite addition to NEXA, actually, from the retail space that we're really excited about. And we see these guys, a lot of these people are now reaching out. Significant people saying, look, we're interested in doing this. Where would I fit in? A lot of the management, they don't understand where they fit into the mortgage broker space, because they look at mortgage brokers as if they were just some little tiny peddly companies that were annoying in the past. Right now, you have these mega brokers like NEXA, like Barrett,
There's like 10 or 15, right?
Yeah, these really large brokers that you can't ignore this anymore.
That's what we call them, the bigs.
So, yeah, so you can't ignore them anymore, and they are there, and they are attracting those loan officers. It's harder to get those big players, but those big players, they are absolutely right now talking to us. It takes a lot to move that ship, so they're not going to do it overnight, but they are moving. I'd say 5% is probably a minimum if those things start moving.
I mean, I think by 2030, it's going to be over 50% of the market by then.
So
yeah, I think there's going to be at least a 5% shift.
I'm extremely excited by what we see going on with the opportunities that are out there in the wholesale side. And I feel blessed that I feel like I got into the wholesale side at the absolute perfect time. And Eddy did me a favor. In 2017, Eddy fired me from Equity Prime Mortgage. And,
True story.
I opened up NEXA Mortgage, and we have now become phenomenal partners. We have done so much more together.
Yeah.
And in this kind of a partnership than we ever were going to do.
Well, it's what I told you. You weren't, I know who's a retail guy or gal, whatever you want to say, and I know who's more third party. And I said that, I'm like, you're not retail. Like, there's some people in wholesale, I've been like, okay, you want all this service? You need to go to retail because it has its spot. I'm not one of those that's against it. You just have to know what the game is as an originator, what game you want to be in as an originator.
That's right.
And that's what I knew. I was like, dude, you're an independent, you're a flex guy, you're a flexibility guy. Like, this is, retail, it's about wash, rinse, and repeat. I'm keeping it just tunnel, and that's perfectly okay because a lot of people thrive in it. But yeah, I knew from day one you were not a...
Well, we changed our name recently from NEXA Mortgage to NEXA Lending for a reason, to make the point that we are no different than retail loan officers, right? Except we get wholesale rates, and we actually have more control. They always focus on the underwriting, and the underwriting, you don't have more control in retail. I do over 60% of my loans, I fund them myself, and I disclose them in my name. So I will have one of our awesome NEXA 100 lenders, and look, we all know that companies have overlays. But at one company, one underwriter will have a different overlay than the underwriter at the same company. So if an underwriter gives me a silly condition, I'll just call up and say, Eddy, can you get this file underwritten in 24 hours? It's a rush, I got a whole thing, right? This is the condition. So yeah, we'll rush that thing through. And I'm right back to docs. And I don't have to worry about redisclosing because the disclosures were already done in our name. So we are absolutely no different. And we're starting to see this. What we're really starting to see is the management levels of all of these retail places, because relationships still matter. Yeah. And retail has been able to retain its top talent specifically because of relationships a lot, right? They do matter. But these people are like going to their friends that are in these industries and saying, what am I supposed to do with these? And these relationships are starting to crumble a little bit. Well, these middle management guys or these upper management that control large swaths of production are now starting to reach out and say, how can I fit into this world, right? And so we're welcoming them, and we're saying, listen, if you can bring the production, we have a revenue share model that is out of this world for those people, and they're finding their their 7-figure incomes at NEXA with no problem. So we're really excited about the shifts because we're finally seeing those upper management of those retail places really starting to reach out and say, hey, okay, maybe there's a better place for us, and maybe we should look at this. So they're taking brokers pretty damn serious now. That's for sure.
We don't consider this a bold prediction, it's just reality, right? So non-agency has doubled year over year for the last 3.5 years, and it's going to continue on that upward trend. So we're in a market that's going to show $300 to $400 billion with a non-agency product, and there's a good chance that that doubles again into next year. So now's the time for a loan originator, broker, pick your loan originator naming convention, to become an expert on non-QM, RTL, second liens, construction, right? There's pockets underneath that. Really, this is just providing liquidity and lending opportunities for the 20 million self-employed human beings that are in America to become borrowers to buy a home, right? It's tapping into the 30% of the market that's controlled by residential real estate investors. It's actually having a conversation with every homeowner in America that has equity and an opportunity to grow their wealth through having another conversation about how to set up their financing on their home. So we're here to stay. It's going to continue to grow. So I think the bold prediction from our side is, can that 300 equal 600 over the next 12 to 18 months?
It sounds like an exciting time in all three places. It looks like 2026 is going to be a big year in the mortgage market. Really looking forward to it. Thank you guys all for coming in and sharing your insights this morning, especially early on a Saturday morning here at NAM National. That's going to wrap things up for MPA TV. This time, I'm Matt Sexton. Thank you so much for joining us. We'll look forward to talking to you again next time. See you then.